So, what is syndication? Syndication is basically pulling together money. One person is going to go out and operate the property, operate the organization that's going to buy the real estate in this case, right? You can syndicate pretty much anything in life. You can syndicate a Snickers bar if you choose to do that, right? But we're going to talk about real estate. So a syndication is when a group of investors come together, pool your money. You're going to go out and buy, 5, 10, sometimes 20 times more than you could have bought on your own. There's typically going to be one person at the head. You're going to have one operating partner, one sponsor, somebody that puts it all together and kind of manages the entire process. So it's a way for many people to come together where most people don't have to do any work at all. You're depending on one person, the lead investor, the deal sponsor, or the operator to generate your returns. Again, it's a way to scale, which is fantastic. So let's talk about a few pieces of the syndication model. You're going to be a syndicator, right? You bought this book because you're interested in syndicating. So why do you care about syndicating? Yeah, you can get bigger, but what does that really mean? Bottom line. All right, so let's talk about how to monetize your syndication. There's a bunch of different ways you're going to get compensated. You choose what works for you. Every single syndication and every single syndicator will do this differently. But these are some typical ways that you can be compensated for the risk and the liability that you're going to take on and the headache, right? You're going to be managing all this while everybody else keeps going to work, hangs out with their kids or travels, whatever they're going to do. So to monetize syndication, you're going to have, very often you'll have an acquisition or disposition fee and sometimes even a refinance fee. So basically those are all capital events. So you acquire the property. Disposition fee means you're selling the property, or again, a refinance fee. On an acquisition fee, those are usually anywhere from 1 to 4% of the acquisition price of the property. It typically does not include any other monies you have to bring to the table, operating capital or closing costs or rehab money that's not in the loan. It's typically only going to be based on the price of the asset itself. So if you have a 1% acquisition fee on a $20 million property, you're going to make $200,000 for your time and effort. Same thing on disposition fees. Disposition fees are usually 1 to 2%. They usually don't get as high as 4% because it should be a much higher number. Same exact thing. Once you sell the property, part of the fee structure in that sales process, you're going to pay real estate transactional fees to a real estate agent, basically. Well, this is just another fee that's going to be loaded in there with it. The disposition fee will be 1%. So let's say your $20 million asset, you turn around and sell that property for $30 million. You get 1% of that, so you'd make $300,000 there. Same thing with the refinance or what's called a supplemental loan. Anytime bulk money comes out or comes in, you're taking a piece of that. One thing to keep in mind here, the acquisition, disposition, and basically all of these fees, this is ordinary income. So you got to be very, very careful with how you structure this. Talk to your CPA. If you have a tax advisor, a tax attorney, make sure you know what you're doing. If you buy a $20 million asset with a 2% acquisition fee, that's $400,000, and that's actual income. That's ordinary income. It's not passive income. You don't get all the special tax treatment with that. It's just like going to work at 7-Eleven, right? It's exactly the same thing. So if let's make it very simple. $400,000, if you're in a 20% tax bracket, that is going to be an $80,000 hit payable right away. So be careful how you structure these. I personally don't have any of these fees, but that's for you to decide. So next you have the asset management fee. And what this is, it's an ongoing fee. Usually it's 1 or 2%. And it's the ongoing fee paid on a monthly basis to the asset manager. Typically you will be your own asset manager. I am my own asset manager. And what that is, that has nothing to do with the daily operating of the property. That's property management. This is asset management. This is the fee paid for managing the acquiring entity of that apartment complex, right? So you're going to structure an LLC. The LLC will then go out and buy a property. It's that acquiring entity that you're getting compensated to manage. And the way you are compensated on that, you're going to get the 1 to 2% that we talked about, and it's going to be on gross collections monthly. So let's say you have a property that you bill out $100,000 worth of income every month for rent. Let's see, admin fees, late fees, application fees, laundry income, RUBS income, all this stuff. Any dollar that comes in, you build out 100,000, but you were only able to collect 50,000 of that. That's horrible, first of all. But you're only able to collect $50,000 of that. You're only going to get your 1 to 2% of what was actually collected. That's the asset management fee. Then you've got property management, which we just talked about. Property management is usually you're going to farm this out to somebody else. You're not going to manage your own properties. Most people don't. It's a lot of headache. It's the hardest part of owning these properties. But whoever you have those properties managed by, you're going to pay them anywhere from a 3 to a 10% fee, depending on the size of the property. If you self-manage like I do, that's a fee that gets paid to you or to your management company, right? So that'll be usually, like I said, 3 to 10%. Same thing as the asset management fee. It's going to be charged against the collected revenue, not the billed revenue, but the collected revenue. Then you've got the promote. This is the big deal that most people do this for. So the promote is an ongoing thing also. Anytime cash flow or anytime cash goes out to the partnership, the promote, some people call it an override, is the percentage of that you take as a premium. Very simplistically, let's just say it as an override, right? So let's say you have an 80-20 split, which is very common. Sometimes you'll see a 70-30. On an 80-20 split, that means your promote is 20%. For the effort of running this asset, this organization, on top of the asset management fee and the property management fee, if I send out $100,000 again in profit to the partnership with an 80-20 split, I take the first 20% off the top. So I put $20,000 into my pocket. Whatever's left, the $80,000, all of your limited partners share pro rata in that leftover. So if somebody puts 10% of the money into the deal, they have $80,000 left over. They get 10% of that $80,000, so they'd get an $8,000 check. That's what your promote or override is. It could take all kinds of different forms. You decide with your SEC attorney how you want that to be structured, because you got to make sure you do it legally. But again, there's all kinds of iterations out there of how you can do that. And then you have the preferred return. Preferred return is designed to try to look out for the limited partner. Now, when I say try, because a preferred return, some people think it's a guaranteed return. It's not guaranteed at all. There's nothing in this that's guaranteed. Everything we're doing comes with some degree of risk. But what a preferred return says, let's go back to our example that we sent out $100,000 in cash flow distribution, right? Our profitability. We send that out to the partnership. You're going to take your 20% off the top. Everybody's going to get their pro rata share of the remaining $80,000. Well, the preferred return says, let's say you have an 8% preferred return. Typically, the way a preferred return works is that before I take my 20% promote, so before I get my 20,000 piece, you're going to have to make sure that they hit their 8% preferred return. If they don't, you get none of your promote. Everything above that 8% hurdle, so let's say you have a 10% return based on your distribution. Everything above the 8%, so that top 2%, that's what you get your promote on. That's it. The first 8% goes to the limited partners, which very often you will be a limited partner as well, because you're going to put your own money into these deals almost always. But until they get their 8% return, you're not going to get your promote. I don't do preferred returns. Why? Because I also don't charge all the other fees we talked about. There is no acquisition fee. There is no disposition fee. We don't do refinance fees, right? So if I want to leave that huge chunk of money on the table, I'm not going to pocket that for my time, effort, and liability. I've got to be paid somehow. And that's why I don't give the preferred return. Because if I give a preferred return, that's a huge chunk of my income for all this work that I'm not getting. So I don't do preferred returns, but because of that, I don't do acquisition fees either. So those are the basics, very high level basics of the ways you can go about compensating yourself. It's open to your imagination how you compensate yourself. You got to make sure you do it legally. And the biggest part of it is, on top of the legality, you have to make sure that whatever you structure, you can get people comfortable with and be willing to give you money to invest in your deal. So the next thing we're going to talk about, so that was all the compensation piece. Now we're going to talk about taxes. This is a little off base. It's not directly attributed to the syndication, right? But taxes, we'll hit on this briefly. Why do we invest in real estate in the first place, right? We're talking about syndication, but we're talking about syndicating real estate. Why do we syndicate real estate? Because the tax treatment is ridiculous. It's so good, it's totally legit, it's totally legal. But if you structure this right, you're going to defer all your taxes for the most part. You're going to get cash flow distributions throughout the year, and you're not going to pay taxes on those because something called depreciation. When you go out and you do your personal tax return, your 1040A or your 1040EZ, whatever you're doing, the way it works is you're going to put your top line income. Then after that top line income that you made from your job or whatever, you're going to start layering in all of the different deductions. I'm probably going to butcher some of these because I'm not a CPA, don't do my own taxes, but you probably have child deductions, you have mortgage interest deductions, you have home business deductions. You've got all these deductions that you're trying to whittle away what your adjusted gross income is. You pay taxes on what is left after all of your deductions. Investing in real estate, you are actually investing in a business. You have a real estate business. These assets have the exact same process. Top line revenue, and then you start layering in all the expenses. A lot of those are payroll and marketing and utilities and all that stuff, but the biggest piece of that is going to be depreciation. The money is a big part of it, and then the time is the other part. The faster I can scale safely, I'm not going to scale recklessly, right? I'm not going to get over my skis out ahead of myself and be reckless with myself and other people's money, right? But the quicker I can get to true scale of say 400 to 600 units, maybe 500 to 700 units, you're going to start buying your time back. Because at the beginning in your syndication process, in your syndication business, you're wearing every single hat. That's just the way it is. You don't have enough income to be able to bring other sophisticated and qualified people into your world. Once you do get to that 400, 500, 600, 700 unit scale, now you can start bringing in people at the corporate level, basically. I have an operations director. I have bookkeeping. I have, this is going back into my management company, but I also have regional managers. All the jobs that I had to do at the beginning, well, I've got scale now because I was able to use other people's money to go out and get all of us a good return. Well, now I have enough money to afford all these people. So what that does, instead of working 30 to 40 hours a week at this, now you might only be working 5 to 10 hours a week at this. Don't fall in love with the 5 to 10 hours a week because at the beginning you're going to work your ass off. Don't let anybody tell you any differently than that. And if you are not ready for that, do not do this. If people don't like you, if you don't like people, this is not for you. To make this really work, people have to like and trust you. And you have to be transparent. You have to be able to get out in front of people when something goes wrong. We talk about that all the way through the book. All the people that I talk to about this, that's the number one thing I hit on. Do you have a personality that people are drawn to, that people like and trust? And can you get out in front of problems? If you're going to hide from problems, you just put your head in the sand and you hope, oh, it'll go away. It's not going to go away. I swear to you, it will not go away. It's going to fester and get bigger and get worse. So the you factor is the biggest part of this whole thing. If you have it, great. If you don't, please, again, be self-aware. Because if you're not self-aware and you think, oh, but I can make it work or I can change. No, you can't change. You're not going to change who you are. You are who you are, right? So be real with yourself.